Go.
Okay, so we're company C, and name is CCD, which stands for cameras and drones. So in brief introduction to our company, we have made our strategic mission that we define it as we're creating long-term value for customers and differentiate ourselves with a broad international market. So our strategic plan. We originally started as to want to be the best cost company. However, it was very hard to reach that point. So our first, using year 6 as our experimental year, we started as a sort of focus differentiation because we assuming our competitors will raise their quality in their products, but like 3 companies wouldn't have enough cash to generate from previous years to invest in the marketing expenses. So we decided to first start with focus differentiation, and then through year 7 to year 9, we are going to a broad differentiation strategy. And after that, we kind of sort of struggling with it because we find we don't have a very defined strategy to compete with our competitors. So we are adapting a more flexible market strategies to put us in a better niche in the market. And for the year 12, because we find our market shares kind of merged by company A, who is our main competitors for high quality products. So we started to put ourselves in a blue ocean strategy. Then we decided to develop towards our best cost goal.
Our product strategy and how it shaped the rest of our business decisions. And our guiding principle was to produce high quality products efficiently. To do this, we prioritized component upgrades over warranty extensions. For example, our AC cameras component cost reached $163 per unit, and our drone reached $960 per unit, which placed both products among the highest quality offering in the industry. And labor cost per unit was $29 for cameras and $41 for drones, allowing us to maintain strong margins without sacrificing quality. Because of these decisions, year 12 operating profit was strong. And in North America, our camera earned $165 per unit, and in Asia Pacific, our drone produced $438 per unit in operating profit. So overall, our production strategy established a stable foundation, high quality and efficient labor use, and strong profitability. And now let me walk through our marketing strategy, which involves significantly across the simulation. In the early years, we took a very cautious approach, keeping advertising budgets quite low and investing minimally in retailer recruitment. This helped save cost, but also limited our ability to communicate our strong product quality to customers. So the second issue was regional misallocation. We initially emphasized North America and Europe, Africa, but Asia Pacific and Latin America had higher responsiveness to advertising. So for example, the Asia industry benchmark for marketing cost per unit was 26, so indicating a region where marketing spending pays off strongly, but we did not fully capitalize on that opportunity. As we recognized this gap, we shifted toward a broad differentiation strategy, increasing both advertising and retailer support to raise visibility. And by year 12, this produced mixed but positive outcomes. Our camera reached 23% market share in North America, which is close to the industry baseline, and our drone line performed even better, capturing 26% total market share. This pace taught us that marketing must align closely with regional demand patterns, and when we supported our high quality products with targeted marketing, the results strengthened meaningfully. And finally, the key to our year 12 performance was the integration of production and marketing strategy. Our production system consistently delivered high quality cameras and drones with strong margins. This gave us the flexibility to expand marketing when we needed without hurting profitability. At the same time, our marketing decisions began shifting from conservative spending to more strategic and regional investments. By focusing on regions with high advertising elasticity and strengthening the retailer support, we gradually improved visibility and access to customers. Together, these actions produced a stable year 12 outcomes, competitive AC camera market share, and strong drone demand and profitability, and solid operational base that positions the company well for future strategy choices. So, summary, year 12 reflects the point where production strength met smart marketing, but allowing us to convert product quality into meaningful market results.
And I will walk us through our facility strategy, which became one of the foundation blocks of our long-term performance. One biggest strength reflected in our decision report is that we consistently avoid the most common mistakes in the simulation, which is overexpanding too quickly. Through year 8 and to 12, our team matched our workstation capacity exactly to forecasted demand. Because of that discipline, our company maintained overtime levels below 2% in nearly every year. And we are also able to keep up our labor utilization efficient without stressing the workforce. This alignment between demand and capacity is also why our defect rates and warranty claims remain very low. Even as we increase the component quality when we upgrade our camera sensors, LCD screens, and drone frames and GPS system, our process could actually support those warranty costs without the newly uploaded decision reports also shows that the warranty costs did not spike, meaning our production system absorbed the quality improvement without losing control, and that's a tremendous operational indicator. Our team also consistently optimized workers' productivity. For example, by year 12, camera workers are producing roughly 3,092 units per worker, and the drone labor costs stay at also the very competitive $41.87 per unit. These metrics put us in a very strong position relative to this industry, and it wasn't just an accidental, because it's the direct results of a strong compensation, consistent training, and the right staffing level. And our facility strategy strengthened our financial position by resisting unnecessary expansion. We also protect our cash reserves, allowing us to finish year 12 with one of the highest cash balance in the industry. And that cash flexibility allows us to pursue the Blue Ocean strategic in the final year without taking on excessive risk. And next I'll walk up through our compensation strategy, which acts as the fuel behind the strong productivity and low warranty costs I just mentioned. Across the simulation, our compensation choice was designed around one goal: creating a high-skill, low-turnover workforce that could be reliably produce top-tier quality. And also, we increased the wage gradually, but consistently, not too aggressively, but enough to remain competitive. We paid 2% above the industry for camera workers and 8% above the industry for drone workers, which helped us attract and retain stronger talents, especially for the more technical drone assembly. We also used incentives strategically. We added attendance bonuses, which helped stabilize our scheduling, and per unit productivity incentives, which reinforced high performance on the assembly line. These incentives weren't expensive, but they created meaningful behavior impact. One major factor behind our strong production metric was the training, and we invested $6,000 per workers for cameras and $9,000 per workers for drones. This continuous investment kept productivity increasing year after year. You can actually see the results on our warranty data. The warranty claim also always stayed lower than expected, even while our component quality rise. This is exactly what you want to see when you invest in people, better output, but not just higher payroll. And all these compensation choices also contributes to our image rating. Treating employees well is also part of the CSR, and it played a role in maintaining our strong score in the end of the simulation.
So let me explain our corporate citizenship strategy and how it supports our overall business approach. In our company, CSR was not just an extra cost. We use it as a core value of our broad differentiation strategy. Sys Globus rewards companies for strong image rating and also for responsible behavior. We treat CSR as a long-term investment that could improve our reputation. It can support our worker productivity and reduce operation risk. Across year 8 to 12, we focus on 4 major CSR actions. Firstly, we continue growing initiatives every year. These programs help reduce waste and pollution, and they match customers' expectations for environmentally responsible products. This also supports our brand image, especially in the high-income market. Secondly, we increase spending on renewable energy. By year 10, we invest about almost $3 million in solar and clean energy system. This decision helps us improve our image rating and also lower future energy cost. Investors respond very positively to this because it shows like long-term responsibility. And third, we improve working conditions by upgrading lighting equipment, safety, and overall facilities. These changes support higher worker morale and better productivity, which help us our production efficiency and reduce the chance of mistakes. And lastly, we put in place a supply code for conduct. This helps us avoid unethical sourcing, reduce companies' risk, and reinforce trust in our supply chain. It also matches the expectations of society responsibility investors. So together, these 4 CSR actions strengthen our broad differentiation strategy. They help us build a strong company reputation, support long-term competitiveness, and improve both initial performance and external brand values.
So you stole from Trip Trap, right?
And when we look at our CSR spending from year 8 to 12, we stay very constant, usually investing between 6.7 million and 10 million every year. The steady investments help support our image rating and maintain trust from both customers and investors. Our important movement was in year 10, when we made a major increase in the CSR spending. We can see from here, and the 3 million renewable energy upgrade. This was a turning point because it improved our long-term environmental performance and helps our image rating rise in the later years. When choosing where to spend, we always focus on CSR actions that brought real strategic impact. For example, the green entertainment and working place updates were repeated every year because they boost both our brand and our internal productivity. The supply code of the conduct helps us avoid risk in our global supply chain, which could have damaged maybe our reputation if something went wrong. And one interesting thing is like we didn't spend like any money on the charitable donations.
Right.
The donations help the CSR scores, but they don't improve like operations or reduce costs. So instead, we put more money towards actions that have a stronger return over time. Overall, our CSR strategy helps us stay competitive in the markets where image rating and reputation strongly influence on the customer's purchase decisions. It also supports our brand broad differentiation strategy and helps maintain investors' confidence. By being constant and software with CSR, we build a stronger for a long-term financial performance.
Our financial strategy played a critical role in enabling the production and marketing decision we executed throughout the simulation. Rather than pursuing rapid expansion, we focused on building a financially resilient foundation that allowed us to respond flexibly to competitive pressure. For the margin management, first we focused on profitability fundamentals. We selectively increased component quality where it had the highest impact on product performance, but avoided overspending on area like warranty extensions that would have reduced component investment. Thanks to this disciplined cost structure, our year 12 margins remaining strong and with 40% of gross margin and 60% net margins, giving us the internal cash flow needed to fund strategic shifts. And debt leverage discipline. Our use of debt was conservative and intentional. We only borrowed when strategically necessary. By keeping our capital structure consisted of roughly 70% of debt and 30% of equity, we avoided financial risk while preserving our credit rating at A. And liquidity was central to our strategy. We accumulated more than 400 to 24 million in cash by year 12, and the strongest position in the industry. This allowed us to upgrade drones in the later year and invest in retailer recruitment and ultimately pivot to evolution strategy without facing financial constraints. And finally, we focused on consistently on shareholder metrics, earning per share and return of earning and stock price. Although ROE pressure increased in year 10-11, our earlier financial discipline kept us competitive and maintained investor confidence. And our credit rating and stock price reflected this long-term stability. So our financial strategy balanced stability with strategic flexibility. It allowed us not only to sustain strong performance in year 12, year 7 and 11, but also to execute aboard strategic repositioning in year 12 that set the foundation for future competitive advantage.
So here are our financial outcomes. Next.
And let's look at how we position ourselves against competitors in this industry. Our guiding strategy from the start was like broad differentiation based on the product quality. The decision report confirms that our PQ rating consistently exceeds industry expectations. For action camera, we achieved 7.1 stars versus the expected 5.9, and in the drone we delivered 6.4 versus the expected 5.6. And this places among the top performers in product quality for several consecutive years. And the competitive data highlights a clear platform. While many of our competitors rely heavily on discounting or aggressive advertising to boost short-term sales, our team invested in sustainable competitive advantage, which is quality, reliability, and worker productivity. A As a result, our market share grows steadily without the extreme fluctuations seen in the low-cost competitors. Our strongest performance was in drones. We maintained 25 to 27% global market share, outperforming several teams who attempted low-price strategies. This is driven by strong margins, high PQ rating, and efficient operations, all tied to our facilities and compensation decision. And in the action camera segment, our market share remained in 23 to 24 range. We produced excellent products, but some regions required more aggressive market investment earlier in the game, and that's a key learning. Even the best product needs consistent visibility. One of our most important strategic move we made was a shift in year 12 toward the blue ocean best cost strategy. While our competitors continue refining their existing position, we use our strong cash reserves and operational efficiency to offer high value at a competitive price point. That shift allows us to preserve strong margins while improving our competitive position across the region.
So our strategic evolution, basically, what we can conclude in this evolution for our strategies is we are making trade-offs each year. We are making trade-offs to compare our benchmarks with our competitors, so that you can see some of the years our PQ also retreat a little bit back in order to sustain our profit to be dominant in the market. But generally, it's all more what we have learned is that we should be more adaptive to our competitors, so that we could survive in the market. And so next, I will show you how we evolve in dynamic trends. So starts with here our cameras. You can see our market share is sort of overshadowed by company A. And here is our drones. So we have already learned that we both put ourselves on the high quality product end, and that's where we sort of develop sort of a focused differentiation strategy, and then we merged. And so we realized it, and then we started to invest our money in marketing, and so it's evolving. And then you can see our market share becomes higher and higher. And until year 11, we sort of find ourselves, because we are putting ourselves a higher price than company A's products. However, with their products with near PQ ratings, and we find ourselves sort of dangerous. So we sort of kind of cutting back our marketing expense for that part, and then you can see that in year 12 it's evolving again. So I would say it's an experiment that successfully put us on a different position in the strategic map, but still we need to find out what's going to happen in the future, that how could we develop our market share.
Right.
And for our drones, sorry, it's too quick. So it's immediately, you can see we have expanded, we have invested a lot in expanding our market share. However, sort of in year 12, we are cutting the marketing expense back, so that we are putting ourselves in different position. And this is our EA. So starts with Memrose. It's also the same as NAs. We always put ourselves the same kinds of similar products with company A, and finding ourselves having a very rigorous market share with company A. And then you can see as we started to invest more and more, our cash generated from previous years into the marketing expense, we sort of put ourselves towards the different broad differentiation, but then they are behind us, and so we have to make the blue ocean strategy accordingly. And yeah, sort of out of my expectation is that after we using the blue ocean strategy, we sort of enlarge our market share. And yeah, and back to year 12. So here are our drones. You see our broad differentiation strategy, and then we're developing to the high end, but sort of we emerges again at the similar position. And so this is where we make very different decisions in year 12. We're cutting the expense for marketing. And Asia Pacific, different positions. We have more invested in the marketing, so sort of different parts. And then we started to evolve towards broad differentiation, and then we merged again. So, sort of cutting back the budgets and for the teams. You can see how our strategies sort of kind of evolve and towards both like product quality improvement and marketing expense increase. And then,
So these are different years, right?
yeah,
Okay.
from year 6 to
Okay.
year 12. Okay, so next is our Latin America, and we start at low end, and then high quality, and then high end. So noticing here, we merges again in year 11. That's where we introduced more features for both of our products. For cameras, we introduced 3 more features, and for our drones, we introduced 7 more features. And then we sort of get back the market share. For the drones,
Hmm.
okay, next. Year 12. So here is what I want to explain a little bit about what we find in the investment for our products and the marketing. So I will not put ourselves into like
That's
seeing
product, you said?
PQ reading.
Oh, PQ, okay.
So, so we are not defining each region as like more price elastic or less price elastic. Instead, I find that out for the PQs in Latin America and Asia Pacific regions, with PQs increasing and with more marketing, we invest, the slope sort of kind of become less and less, which means what I mean here is that customers react less effectively to our conversion of the marketing expense. If the PQ is low and we invest more in the marketing expense, competitors would be more price elastic, and then they react more as we sort of putting more marketing expense in, and so a very little bit increase in our marketing expense will induce their very large increase in our market share. However, after when the PQ starts to raise and we put our price higher, and our customers will react less, react to what we have invested in our marketing. So, and in Europe Africa and the North America is sort of converted
Converted.
from this one. With low PQs, if we invest more and more, they react less. But as our PQs started to raise and we invest more and more money in the market, in marketing, this sort of very less investment in our marketing can induce a very large increase in our market share. So that's what we found very interesting. So yeah, so as we have mentioned that we want to attain the best cost strategy, however, it's very hard attainable. What we learn is that it's also depend on how our competitors do in their markets. And yes, if you want to do the best cost, you have to hold handle the market information. For example, how would they do in the next years? But sort of interesting is that when we started to use Blue Ocean strategy, and we thought company A would also do the same when they raise their product quality, and we were betting that they would raise their price. However, they didn't. And yeah, so it's still the simulation is just simulation. You have to bet it, but your estimation is not that accurate. You have to be prepared to react to those changes. And so the conclusion, yeah, so accordingly, we are not defining ourselves as to be the role of market leader or cash cow or something, but we want to be the star of the market. But what we find very hard to attain is that you have to both satisfy your investors' expectations, and you also need to raise your PQ and inventory.
Okay, I'm going to talk about the lessons we learned from the global simulation. So throughout the whole simulation, we learned far more than just how to adjust numbers to like in a decision form. We learned how strategy works in a real competitive environment, how teams actually function under pressures, and how many hidden trade-offs managers gonna face every day when trying to balance the profitability, the competitiveness, and investors' expectation. And one of our biggest lessons was strategy truly matters, and early decisions matters even more. In the beginning, our team underestimates how long it takes for a strategy to show its results. For example, we started with lower advertising and limited retailer support in the early years. That created a disadvantage that we kept fighting for several rounds. Once a competitor builds brand recognition and capture market shares, it's become much more harder to pull customers back. So the simulation told us the companies should not be overly cautious as they started. We should be brave to invest in stuff. In a real market, hesitation is also a strategic decision, and sometimes it's a costly one. And another important lesson was the value of data-driven decisions making. Many times our assumptions were wrong. At first, we spent most of our market budget in North America and Europe, Africa, because we assumed these regions were the most important. Later, we discovered that Latin America and Asia Pacific actually had much higher advertising if we had relied on data earlier instead of institution, we would have captured more growth and built a stronger financial position. The lesson here is clear. We have to test assumptions with the real world data. And the simulation also remind me that
Remind me to scroll down.
Remind me that the long-term goals often conflict with short-term investor expectations. There were several moments when we want to increase product quality and build like long-term operation strengths. But investors' pressures forced us to focus on the ROE or stock market price instead. These tensions exist in the real companies as well. Managers have to choose between what looks good today and what will create stronger position in the future. In year 10 and 11, we learned this the hard way as we sacrificed some of the long-term improvements in order to satisfy investors' demand. I guess everybody here gonna have trouble with meeting the ROEs in the year 10 and 11. It's really hard to reach it. And when we look back, I realized the companies need a clear plan for managing both short-term performance and the long-term strategy. We have to find the balance point.
Balance, right.
And another big lessons come from the competition. The competitors in these simulations were not predictable, and that made the experience feels very real. For company A example, we almost match our quality and constant influence on the market share. This taught me that business do not operate in isolations. A winning strategy is not just talking about like something is being good, it's about being better than the others. And we also need to adapt to the new world situations. Our strategy changed several times, from focused differentiation to broad differentiation, and finally we turned into a blue ocean strategy. At first, I viewed strategy shift as a sign of weakness, but through the simulation, I realized flexibility is actually a very strength. Marketing change, competitors change, investors' expectation will also change. So strategy must evolve too. The best performance companies are not the ones with a perfect plan from day one, but the ones can learn quickly and respond faster than the others. Working with my teams also taught me valuable lessons. In the early rounds, our communication was unclear and our roles were not well defined. We played around every columns on the website, and finally I find, I can't remember my result because she already submitted and it's covered my page. And these lead to like wrong decisions, uncertainty, and some performance that we can avoid in the front stage. But as we improve our communication skills and divide responsibility more clear, our decisions become more accurate. I learned that good teamwork is not automatic. It comes from structure, clarity, and also trust. These interpersonal lessons are just as important as the technical ones. And finally, I learned the strategy value of the cooperative citizenship. Before the simulation, I feel like it's just something like good to have, but like not have to have. But in the Globus, CSR actually like strengthen our image rating, improve our productivity, and support our differentiation strategies. It taught the responsible of the business practice are not just ethical, they also help your strategy. In conclusion, the Globus simulation taught me how challenging it is to run a company in a competitive environment, which means the other companies are also doing very well. A winning strategy requires data-driven decisions, commitment, and a balanced performance management. And also, strong communication and the ability to adapt quickly is the key to success. If I could do one thing differently, we would communicate more in early stage, and we will find out invest in more like in advertising, strengthening the drawn line sooner, and rely more heavily on the market data instead of assumptions. But overall, the simulation allowed me to experience with the real managers face every day, and also the pressures from the investors to force us make maybe a wrong decision. So these lessons will stay with us, and I believe it will directly help us in the future career. And that's pretty much all.